How are we doing today, folks? Did you guys miss me complaining about Wednesdays, over the break? Just kind of like said, Dr. Barnes is going to whine about Wednesday. Yep, I'm going to whine about Wednesday a lot because you know the way I am. So we are starting out today. Like I said, I really enjoyed this lecture because it's nice to introduce to the concept of auditing. Before we do, something interesting, Dr. Caden texted me this morning, which, believe it or not, we actually do engage with one another, being enemies, tax and audit. We actually do still interact with one another. But she sent me a clip from a news article. It was about this something Lacey Mosley is holding. It's a true crime series called Scam Goddess. And apparently coming up tonight, this is on Freeform. If you got Freeform, I don't, but it'll be on Hulu tomorrow, from what I understand. Is our episode about somebody called Rita Crundwell. And the only reason I bring this up is because we are actually going to talk about Rita Crundwell later in the semester. In chapter 6, she's the subject of one of our problems about internal controls. So there's been a documentary already made about her. It's called All the Queen's Horses, which is pretty good. It was done by an accounting professor, and given that it's kind of a low production value, it was actually really well done. But ABC's kind of taking their fore in this about their true crime, and they're actually including an auditing case or a fraud case more appropriately. But if you wanted to take a look at that and watch that, I encourage you to do so. I'm going to watch it. It should be pretty interesting. All right. That being said, we've got auditing to learn, so I need to get going because we got a lot to cover in a short period of time. I'm going to start out with a semi-rhetorical question. What is your goal in this course? We're going to learn auditing, Dr. Barnes. We're really excited, enthusiastic. Is that your goal? Is that what your goal? Your goal is to get an A in this course. That's what you want to do. You want to get a good grade in this course. You want to get through this course. You want to have a good grade. Can we say that that's fair? Okay. What is my goal for you in this course? Your goal is to give us A's, Dr. Barnes. And I was like, yeah, well, I guess maybe that's the case. Ultimately, what is my objective? What do I want you all to know? Would it be fair to say I want you to know auditing? Okay, yeah. So that's important to note. Okay. So what about graduating? You all are on the track to graduation, maybe 1 or 2 years away. When you graduate, what's your goal? Default answer, say get a job. Okay. If you could make money without a job, would that be an optimal goal? So your goal is not necessarily to make money or to get a job. Your goal is to have a means of making money and supporting yourself. Is that a more accurate statement? So people are going to hire you for these jobs. What is their goal? Is their goal to pay you money? No, their goal is for you to do work that will help them earn money. So the reason I bring this up is we're going to notice here that these are not the same thing. Okay. These are not the same thing. My goal and your goal in this class is not the same thing. Your employer's goal and your goal when you get a job are not the same thing. And it seems like a small difference, but it's a really important distinction to make. All right. So with that point, we're going to talk about something called principal agency theory, or principal agent theory, which it's called agency theory, but it's principal agent theory also is in the vernacular. Has anybody heard this term before? Okay. So agency theory is basically the root of auditing, and we need to be able to define what we mean by that. So in an organization, if I say I've got principals and agents, by definition, who are the principals? Does anybody know? Those are the absentee owners of an organization. So you know them as stockholders. You've heard them talked about as stockholders in financial accounting. Most owners of an organization do not oversee the day-to-day operations of the organization. So who does that? Those are the agents. What is a better term for agents that we would refer to as from an accounting vernacular? Managers. Yeah, managers of an organization are the agents. Okay. So principals hire agents to oversee the operations, the day-to-day operations of the organization. Now, that creates a bit of an issue because that means that principals do not have day-to-day insight of the organization. They do not see what's going on. And so we've got people who are running the organization to see everything that's going on in the organization, and they know everything that's going on, but the principals don't. That is a concept called information asymmetry. There's a disparity in the information between that known by the principals and the agents. Now that can create a little bit of an issue because that means agents can get away with things and the principals will never know about it. But you already know a little bit about how principals have addressed this problem. Remember you took Accounting 220, and what was the focus of Accounting 220? You learned about journal entries, you learned about how to record these transactions, but ultimately what were you aggregating in 220? What was your end result? Financial statements? Learned how to create those balance sheets, learned how to create those income statements. Why do companies insist on financial statements? It's because they want to see what the performance of the organization is over a period of time. Who's the primary target of that? That's going to be the principals, the owners of the organization. So the managers basically say, here's how we're doing our job. We're going to create these financial statements. We're going to give them to the stockholders and other stakeholders, but primarily the stockholders, and say, here's the information that we show that we're doing our job. All right. And so can we say that's a mechanism of trying to reduce information asymmetry? Yeah, that was the ultimate goal of creating those financial statements in the first place. Now, that exists a problem. Is it possible, heaven forbid this could happen, but is it possible the managers could put phony information or fictitious information into financial statements? I don't know that it's ever occurred before, okay? But it's certainly possible that's the case, all right? What is the reason for that? Why would managers want to do that? Well, keep in mind that incentives are different for owners of the organization and the managers of the organization. Let's say you're a stockholder. You have you're ownership of a company. So you have ownership in Amazon.com. All right. Or I don't know why I call it Amazon.com. It's still just Amazon now. I'm still back in the 2000s when it was Amazon.com and it was a textbook company. All right. So you are the owner of Amazon. What is your goal for that? You would like the value of your shares to increase over time, but you would like the company to exist in perpetuity. Is that a fair statement? Because you're trying to generate wealth. You're trying to generate long-term value. The executives of the company, are they trying to generate long-term value? Are most executives going to be there for their entire life? No, they're really short-term focused. They're saying, I really want to make my bonus this year. I want the company to do well enough that I earn that additional bonus. So there's a long-term versus a short-term focus, which is an incentive problem. It's an incentive problem. That example it kind of illustrates this idea of conflict of interest between the organization or the stakeholders and principals and agents. So all of these things come together to create an incentive for managers not necessarily to do their job that the stakeholder or the stockholders have hired them to do. So how do we fix that problem? That's where we get in the auditor. That's where the auditor comes in and says, here's what I'm going to do. I'm going to take a look at these financial statements and I'm going to determine, did the managers do the right job in creating the financial statements? Are the financial statements accurate? Are they correct? Do they reflect the true position of the company? So you can kind of break this down into a little bit more detail and a little bit more focus. Now, we're going to get into the details and the nitty-gritty about this and what this represents, but let's go ahead and think about this from the conflict of interest perspective, okay, the role of the auditor. And I want to use this as kind of a template, all right? So again, we know that your incentive in this course is different from my incentive. Can we say that's the case? You all want to get a good grade in this course. You want to pass the class and do well in the course. I want you to learn auditing. Is there a way that I can align those incentives? Yes, if you learn auditing, then I can actually give you a good grade. What is my mechanism for evaluating whether or not you do or you know auditing? So the exams, the red picture like there. Yeah, you remember that from AOS, that first page right there? That's exactly what it looks like right there. All right. People want to hire you. Okay, they want to hire you so that you can do work for them. You want them to pay you a reasonable salary. Is there a way to align that so that they can actually make sure that they're paying you is worthwhile? What are you going to deliver to them that's going to help them if I make that evaluation, to make that test? So you guys have probably already been working on it. It's that fancy resume, that kind of lists out all that information there. That's not really a resume. It's actually my curriculum vitae, because when you're an academic, you call it something fancier than a resume, okay? Which I think that's really odd because a resume already has two, I don't know what those dots are, but above the E's, it always has that emphasis, syllable emphasis. So it can't get that much fancier, and yet academics are like curriculum vitae. We're going to be fancier than that. I am going off the deep end. Sorry, guys. All right, you're all used to it by now. All right. So auditors do the same thing. They're going to actually perform tests, and at the end of the test, they're going to prepare a report. Now, I haven't updated the slide. This is an old version of the report, so you don't need to focus on what the detail is, but you'll notice this is independent audit report. Auditors are going to report on the position of the organization. So this is kind of the representation of the principal and agent and the role the independent auditor is. The auditor is hired by the principal to determine that the agent, the managers, are doing their job, or they're preparing good financial statements. To a lesser degree, they're also making sure that the risks that are inherent in the organization are being addressed. So I'm going to harken back to AIS. We talked about risks in AIS. What is a response to a risk called? Does anybody remember? Control, yes, control. So we're going to make sure that controls are operating properly as well. That's part of all the auditor's responsibility. Make sure that all that takes place. All right. So keep that in mind. Let's go ahead and let's talk a little bit about how we characterize these thoughts, these philosophies, from an audit perspective. The first step where we need to understand is we need to understand these ideas of assertions, all right? Now, what assertions are you making regarding this course? I'm going to say, I learned this information, Dr. Barnes. I deserve a good grade in this course. Can we say that that's an adequate assertion? That's the representation you're making? All right. How will I test these assertions? Exactly through that word. I'm going to give you tests, all right? Say, you know the information that I've taught? Prove it to me. Prove it to me. I'm going to give you an exam. In the resume example, okay, there's the accent marks I was talking about right there. What assertions are you making regarding your qualification for the job? I am qualified for the job. I deserve the money that you are willing to pay me because I will do the job effectively and I will make you lots and lots more money than you'll pay me. Can we say that that's an adequate assertion? That's an adequate assertion that you're making? How the prospective employer is going to test those assertions? They're going to review your work. They're going to make sure that they understand that when they hire you, that you're qualified. They're going to do reference checks. They're going to do all kinds of background to make sure, and then they're going to monitor you as you do your job. You do a consistent review of your work. So they've got mechanisms in place. Basically, you are making an assertion. You're making an assessment of where your qualifications lie, both this course and with your job, okay? From an audit perspective, we actually use that term. We actually use that term called assertion. What this means is, in the financial statements, management themselves are making assertions about the information that's being presented in the financial statement. If we look at the line item like inventory is an easily changeable one to identify. So you see the line item, it says inventory is $1 million. When they put that item in the financial statements, they're saying you could go out to our warehouses and you could look at the inventory and see that the inventory that we have on hand has a value of $1 million, that it exists, it's sitting in the warehouse. And then if you looked up the inventory that's on hand and compared that to what we paid for it, that it would be properly valued at that. These are examples of assertions related to these items that are in the financial statements. And these form the foundation for how we approach auditing. Now, what are these assertions? I'm going to give you a list of them. Right now, I want you to know the list. I just want you to mostly know that these assertions represent how we characterize risk from an audit perspective, because we're concerned about the risks in present organization and how this is how we characterize risk. You don't need to know too much specifically right now about these assertions. We will get into them in chapter 5. We'll spend a lot of time talking about them over the rest of the semester. But right now, this is a brief introduction. So the first 3 are what I call the 3 most important assertions. And by the way, when you hear the word assertion in this course, you're going to be hearing it as management assertion. You can hear it called audit assertion. I'm also just going to use the word assertion. This is going to change your frame of reference because that word forever now is going to actually mean what I talk about it means. You're going to go out in the real world and says, I'm making an assertion. And you're going to say, oh, an audit assertion. It's like, no, what are you, a lunatic? But you're going to think audit assertion because we're going to use that term so much in this course. What are these assertions? The first 3 I'd say are the most critical assertions. These are completeness, existence, occurrence, and valuation, allocation, accuracy. Completeness basically means, did something get recorded? All right. Something that should have been recorded, did it get recorded? All right. Existence occurrence. By the way, you don't need to write down all of these again. I promise that we will visit these. I'm going to put these up there for reference, but you don't need to take detailed notes on these. All right. Existence occurrence basically says something got recorded, but does it exist? All right. Inventory was in the financial statements. Can we go find that piece of inventory in the warehouse? All right. That's an example of existence. Valuation, allocation, accuracy. Is something properly valued? Was it recorded at the proper value? These 3, I call them the big 3 assertions. I will say majority of the assertions that we're going to deal with will be represented by one of these 3 concepts. So it's really important to understand these 3 concepts. They're ever present. Some lesser known ones, rights and obligations. Does an organization have the right to have an asset on their financial statements or the obligation to pay a liability? Then we have presentation and disclosure and classification. Presentation and disclosure is something properly presented in the financial statements. Classification is something properly classified in the account. Okay, so should it be a short-term versus a long-term example? Then we have cutoff. Cutoff basically says, does something get recorded in the proper period? By the way, I want to make a note here. You will notice that I have something or letters saying PCAOB and ASB next to those. Is anybody familiar with either of those 2 abbreviations? So PCAOB is the Public Company Accounting Oversight Board, which we're going to talk about here in just a little bit. They are responsible for oversight of all public company audits in the United States. These will be the focus of our audits in this particular course. That being said, we're going to talk about other concerns. We're going to talk about private company audit concerns as well, which those are under the purview of the Auditing Standards Board, the ASB. They're responsible for oversight of auditing standards for non-issuer companies or private companies. The ASB is actually a subset of the AICPA, which you should be familiar with, the American Institute of Certified Public Accountants. The good news is that even though we're going to be learning two sets of auditing standards, there's not a big difference between them. In fact, the PCAOB standards were derived from the AICPA standards, the ASB standards. But we do need to actually do a little bit of a differentiation. The reason I bring these up is if you go into the PCAOB standards, you will notice classification and cutoff are not listed there, but presentation and disclosure is, whereas the ASB standards recognize these, but not this one up here. For our purposes, we're just going to recognize all of them. We're going to test all of these assertions and make sure we know them all. I want to throw a last one up here. Got authorization. You're going to hear me talk about this in chapter 5 in my disdain. This is not a real assertion, but it's listed as an assertion in the textbook. It's actually been listed for the last 5 editions, even though it hasn't been an assertion since like 2002. Okay. So why do the authors keep including it? Because they don't want to let go of the past, I guess. Okay. But authorization is a relevant concern to auditing. It's just not a management assertion. So you'll hear me say that a lot. It's not a management assertion. The only reason I keep it in here is to be consistent with the textbook. So that's why I have that listed up there. When we talk about assertions, we can summarize assertions by 2 different levels. We can summarize assertions by transactions and events or by account balances. And it seems really, really difficult to understand, but it's not actually. Transactions and events are basically individual day-to-day operation transactions that take place or events that occur on a daily basis. Account balances are as just they sound, information that goes into the financial statements, what it is that we're ultimately presenting. Why do I make this distinction? Because one point, we'll get to a little bit later on in the course, we're going to talk about phases of the audit. And there's several different phases that we're going to be talking about, but 2 very important and distinct phases will be test of controls and substantive procedures. Test of controls are just as they sound. Remember those controls that we learned about in AIS? I said internal controls, rah, 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 yeah. Internal controls, we as auditors are responsible for testing those controls to make sure that they operate effectively. When we do so, we're going to be focused on assertions over transactions and events only. Assertions over transactions and events only. Which makes sense because controls dictate how transactions flow through an operating system, through an accounting information system. So it makes sense that we would focus on transactions. When we get to substantive testing is basically finishing up all of the testing that we need to complete an audit. We'll focus on both of these categories of assertions. That doesn't mean much right now, but I want to bring that out and make a point of it so that when we start talking about this later on in the course, it will make a little bit more sense. All right, so something you should be familiar with is how we actually are going to be approaching the engagement from the perspective of what happens in a business, in an organization. So in a normal organization, you've got management that implement internal controls and they conduct transactions and they accumulate the transactions and account balances to create those financial statements. And then those financial statements are issued to the users. What does the auditor do? Well, the auditor is going to dictate the terms of the audit engagement, which we're going to talk about a lot more on. We're going to talk about that a lot more on Friday about what the terms of engagement represent. Once the engagement has been started, we're going to obtain evidence about internal controls, about transactions, and about the information in the account balances. We're going to look at the financial statements and we're going to determine what assertions are being represented in the financial statements. That seems like a lot to absorb right now. I will tell you right now, we will deal so much with assertions that it will become second nature to you by the time this course is over. It'll become pretty obvious. But right now you're saying, I don't know how to do that, Dr. Barnes, and that's true. Okay, you've never done that before, so there's no reason you should know how. But the assertions are going to be pretty easy to dictate once we've identified the different types of accounts we're concerned about. We're going to test these management assertions against criteria. And in financial accounting, our primary criteria is generally accepted accounting principles, GAAP. Now, the question will come up a little bit later. Can we use other methods? And the answer is yes. An audit is not required to test against generally accepted accounting principles. If we're doing a public company audit, we would be required because public company audits are required to be under generally accepted accounting principles in the United States. But if we're talking about other companies, if I'd like to do an audit of Greek Corneros down the street, which is one of my favorite examples to talk about, they probably operate on a cash basis. Could I conduct an audit on cash basis? The answer is yes. Okay. I follow basically the same auditing rules. I would just follow a different reporting strategy. So, but for the most part, our default is going to be generally accepted accounting principles. We're going to determine the overall fairness of the financial statements, and then we're going to issue an audit report to accompany the financial statements, which we'll talk about the nature of audit reports here in just a second. But effectively speaking, what we're trying to determine is, are the financial statements free from material misstatement? So that it leads to some interesting criteria. The conceptual procedural details of financial statement audit they build on three fundamental concepts. And these are the three most important concepts for this part of the course. In fact, they're so important that they actually align with the concepts that we're going to be doing in the next three chapters. Chapter 3, we'll be talking about something called materiality. Chapter 4, we're going to be talking about risk assessment. So we'll be building on audit risk. And then chapter 5, when we start talking about our assertions, we're going to be talking about aggregation of evidence. Now, a few notes about these. We're going to talk about these individually in detail here in just a second. But for materiality and audit risk, these determinations will affect the nature, extent, and timing of audit evidence to be gathered. Now, the reason I have that underlying nature, extent, and timing, this is something that Becker likes to call the net of evidence. The larger the net is, the more evidence you have to gather. The smaller the net is, the less evidence you have to gather, which is kind of an interesting visual illustration, and I like using it. So when you hear me say nature, extent, and timing, we're talking about the amount of evidence that needs to be gathered, or the volume or nature of evidence that needs to be gathered. Materiality can actually increase the amount of evidence we have to gather, or it can decrease depending on how we assess materiality. Audit risk can do the same thing. Audit evidence, on the other hand, this relates to the financial statement assertions. We're going to talk about different types of evidence we can gather to test those assertions that we've just talked about. Different types of evidence can test different assertions. So let's go ahead and go into a little bit of detail on each of these concepts. All right, let's talk about materiality. So your favorite band, the Caden Brothers, not to be confused with the Jonas Brothers, is playing 2 dates in Kirksville. By the way, I did ask Dr. Caden for permission to use pictures of her sons. Okay, I don't want them to say, Dr. Caden, do you know what Dr. Barnes is doing in auditing? And she'll say, probably she doesn't want to know. But yeah, I did ask for permission before I put her sons up there. This is actually an old picture. I think these two are like about 10 feet tall now, if I remember correctly. But anyway, you've made the decision to skip auditing class, for shame, to attend one of their performances. You have two possible choices: missing a day that we'll be working on an in-class assignment, which is 5 points, or missing a day we'll be taking an exam, which is 100 points, which you can tell it's been a while because I only have one exam worth 100 points. But for visual illustration purposes, let's go ahead and say that. Which day are you going to miss? Hopefully the 5-point day. Why? Because it's a smaller amount, okay? Relative to the whole, this course has about 500 points. Missing 1 day of an individual assignment's 1%, which you can bounce back to that pretty easily, okay? If you miss an exam, you're talking about missing 2 letter grades, or dropping 2 letter grades, okay? Now, I want to change the criteria just ever so slightly. Let's say instead of 500 points in this course, I say this course is worth 1,000,000 points. Does that change your answer here? Probably so. You can be kind of like, I don't care. I'll miss either one of them. I'll miss both of them. I want to see the concert twice. Yeah. If the bottom line, if the amount of points is much, much larger, then either one of these is going to be insignificant in respect to the whole. This is illustrating the concept of materiality, okay? So materiality, by definition of the Financial Accounting Standards Board, their definition of materiality is information is material if omitting it or misstating it could influence the decisions that users make on the basis of financial information of a specific reporting entity. So if information is omitted or if it's misstated, it would influence the decisions. So usually this is considered in terms of a quantitative perspective. In fact, from an auditing perspective, in the United States, we think of this in terms of dollar value, all right? How much is going to be enough that it would affect a decision? So if I say there's an $1 million misstatement, is that material or not? What do you guys think? Is $1 million material? We're going to go, yeah, we're going to say our default accounting statement, it depends, okay? It depends. Greek corner euros, would $1 million misstatement be material? Absolutely. I probably don't make $1 million in a year, all right? Walmart, would $1 million misstatement be material? Probably not, okay? It is all contextual. We have to actually make that determination based on the nature of the stakeholders and the nature of the organization. And the reason I say the nature of the stakeholders is probably everybody in this room has a different threshold of materiality. So let's say I have an example. I'm going to take money out of your wallet, okay? And at what point will you start saying, okay, this is ridiculous, I'm going to call the cops? Some of you be kind of like, you take $1 out of my wallet, Dr. Barnes, you're losing your job, okay? And which is fair because I shouldn't be stealing money from students, okay? Some of you be kind of like, $1 I don't care about. Dr. Barnes is probably just hungry, and sometimes I am. Yeah. If I take $2, you'd be kind of like, okay, that's annoying. $3, you're kind of like, okay, I'm telling Dr. Caden, Dr. Barnes. And then $5, you're calling the police, all right? but it's going to be different thresholds for different people. We need to determine what would be a reasonable user, okay? Some people would be kind of like, if you get within 5 feet of my wallet, Dr. Barnes, I'm going to call somebody, all right? And that's not even if I have the intent to steal something. That's just saying that I'm just very overly cautious. So that's not necessarily the reasonable user criteria. So a reasonable user of financial statements is something we're going to be concerned about. Now let's go ahead and talk about audit risk, okay? So the auditor standard report that we're going to talk about here in just a little bit talks about their audit provides reasonable assurance that the financial statements do not contain material misstatements. Now, this concept of reasonable assurance is really important, but we need to first of all start out and understand, why do we use that term? Why do we not instead use the term absolute assurance? Can we say absolute assurance is definitely a higher level of assurance than reasonable assurance? Yeah. But why don't we use that term? Why do we say reasonable assurance instead? Well, effectively, absolute assurance is impossible. Think about this course, okay? You want to get an A in this course. If you wanted absolute assurance of getting an A in this course, how much would you have to study? You'd have to study every single minute of every single day from now until the exam to have absolute assurance. And even then, it may not be enough, okay? Would it be more appropriate to say you want reasonable assurance? You want to study enough that you feel reasonably confident that you can do well in the exam? That's the same goal of the auditors, that we want to obtain reasonable assurance. That means that there is a problem, though, okay? There's a bit of a risk, because reasonable assurance is not absolute. There's a possibility that there could be an issue. So the phrase reasonable assurance applies that even when the auditor does their job, so even if you studied for what you think is a sufficient amount, you may not get an A on the exam. Auditor may come in, and I hope that's not the case. I hope everybody studies a sufficient amount and everybody gets an A on the exam. That would be, I'd be pleased as punch, okay? Which is a really, really silly phrase, but anyway, I'd be very happy if that was the case, okay? But if the auditor does a job, there's some risk that the material misstatement could be present in the financial statements. The auditor will fail to detect it, okay? So they do their job properly, but because they're not going to do infinite work, there's a possibility that there still could be a misstatement in the financial statements. Audit risk is that the risk the auditor will mistakenly express a clean audit opinion when the financial statements are in fact materially misstated. This is not the auditor doing a bad job. This is just the nature of reasonable assurance. So when we get into the discussion of audit risk, we're going to determine what are the components of audit risk and what is it that we need to be aware of individually as an auditor, that we can actually minimize this risk of material misstatement, that we can minimize this audit risk, okay? That is going to be what our focus will be here in a few chapters. All right, moving forward, the final thing called audit evidence. Now, again, there's going to be a big long list here. You don't need to write all this down. We will have plenty of time to talk about this. But basically speaking, we're going to be talking about what it is that we can do over the course of the audit to gather information to test management's financial statement assertions. I have a list of, it looks like 8 items here. Technically speaking, it's 10 because there's 2 that are going to be a subset here, which we'll talk about more in chapter 5. I actually put this as a kind of a way to fill up space. This is the Becker acronym for this. It's called the C, the 5 carat wars. They actually recognize 14 different management assertions. The reason I don't use all 14 is, first of all, I think that like several of them are just repetitions of ones that we already know. So we're going to keep it down to these 8 right here. And the interesting thing is there's a very straightforward delineation. There's audit evidence that can be gathered as a result of accounting records, which is basically inspection of records and documents, or things that are not accounting records, all right? So accounting records and not accounting records. The not accounting records is everything else. And we'll talk about the nature of these. The interesting thing is that there's flexibility in when these can be used. There's some variability in what assertions they can test, and there's some reliability concerns. And all of these are very, very important considerations for the auditor to be able to take into account. By the time that we're done looking at evidence, you will know what are the types of assertions that can be tested using a piece of evidence, when can they be used in parts of the audit, certain points in the audit, and then you're going to also know what is the relative reliability. Some of these tests are very highly reliable, and when you perform the test and get good results, you have a lot of confidence about the true state of this the account or the transaction. Some of them are very low reliability. Easy example of this, an inquiry. Inquiry is considered to be a very low reliability test. Why do you think that might be the case? If I go talk to management and ask them a question, why would I not necessarily put a whole lot of stake in what their response is? Is it possible that management could lie? Oh, perish the thought, Dr. Weiss. Nobody's making any head movements whatsoever. Okay. So yeah, it is possible management can lie. They've done so in the past. Believe it or not. Yeah, they've done that. So we want to corroborate assertions or corroborate evidence that has low reliability. And so we need to determine what is the nature of evidence. Is it high reliability, low reliability, and how we can actually utilize that within respect to the audit, with respect to the audit. All right. The end product of auditor's work is an opinion indicating whether or not the client's financial statements are free of material misstatement. Now, when we issue this opinion is going to be issued in what we call a report. The report will actually talk about the nature of the audit and will issue what we believe the opinion is with respect to the client's financial statements. So what are the kinds of opinions that an auditor can issue in their reports? And there are going to be 4 that we're going to be concerned about. The first one is unqualified, okay? And unqualified basically means that everything is fine, okay? Everything's fine, there's no problems whatsoever. In other words, the financial statements are free from material misstatement. This is our quintessential clean opinion. Now, please make a note of this as it will come up. When I say the term unqualified, that is the PCAOB term, the Public Company Accounting Oversight Board term. The ASB, the Auditing Standard Board, they use the term unmodified. Unmodified rather than unqualified. That can get a little bit confusing, as you may see some questions about that in the textbook about unmodified versus unqualified. They're exactly the same type of opinion. They just represent different standards. The good news is this is the only report that has 2 different word terms for it, okay? So unqualified versus unmodified. All the other terminology is consistent across the other types. All right. So the next one we've got a qualified opinion. Qualified opinion is everything is fine except for one thing, or except for these items. So there are 2 ways that we can arrive at a qualified opinion. The first one is that the client breaks the rules. What are the rules of financial accounting? The general rules that we talk about in financial accounting, especially in the United States. Generally accepted something. Generally accepted accounting principles, okay? We also have rules for that in auditing called generally accepted auditing standards, but in this context, we're talking about generally accepted accounting principles. These are what the client failed to follow. They did not follow the rules of financial accounting. It's a departure from GAAP, okay? The second situation is we could not do our job as auditors. We tried, but we were unable to do our job. We refer to this as a scope limitation, a scope limitation. The reason why is when we talk about the nature of work that an auditor performs, that's called the scope of work. If we're not able to do our job, our scope is restricted or limited. So a scope limitation will end up with that. So in this particular situation, if we have a material departure from GAAP or a material scope limitation, it can wind up resulting in a qualified opinion. And the way a qualified opinion works is just as it sounds. We're going to say, except for whatever the item is, the financial statements are free from material misstatement. So except for the 2 words we're looking for in a qualified opinion. All right, then we've got big problems, okay? If we have a pervasive departure from GAAP, so we're talking about something significantly larger than material, a pervasive departure from GAAP, this is an adverse opinion. An adverse opinion. Adverse opinion, you'll notice says everything's a mess up here. Probably the more appropriate way to say this is the financial statements are not free from material misstatement. It'd probably be easier for the auditor to say the financial statements are materially misstated. That's not the way the wording works. The wording says the financial statements are not free from material misstatement. This is a big problem. It's sufficient to not allow the auditor to say things are okay. Basically, this is where we have major issues. A misstatement of this type is going to adversely affect a client's operations, which is why we probably call it adverse. Pervasive departure from GAAP. Then we have something called a disclaimer of opinion. This is for a pervasive scope limitation. This is that our scope was so incredibly limited in our job that we were trying to do that we were unable to do sufficient to obtain sufficient appropriate audit evidence. So we don't know what the true position of the organization is because we could not do our job. When we say disclaimer of opinion is just as it sounds, we are not issuing an opinion because we don't know what the true state of the organization is. We are disclaiming an opinion. That's a pervasive scope limitation. There is one other scenario that can arise, but we'll talk about more about that when we get to chapter 18, okay? You don't need to concern yourself about it right now. For right now, just hold on to pervasive scope limitation, and then you may put in a notation +1 unknown. We'll talk about that more. It's not as relevant right now, but it will be relevant later on. So where we're going from here, Friday, we're going to start talking about chapter 3. We're going to move on to chapters 3, 4, and 5 over the next few weeks. When we get to week 5, we're going to have our exam. Then when we move on to chapter 6 and 7, we're going to talk about internal controls. We're going to jump over to 17 and chapter 18 after that. We're going to have another exam. And then we're going to talk about the different business processes. We're going to learn everything that we need to know to conduct an audit in chapters 3, 4, 5, 6, 7, and then 17 and 18. Then we're going to apply those concepts at the end of the semester when we get to chapters 10 through 16. So we're going to apply them to specific scenarios. So a few things. Auditing is a subset of attestation and assurance. And I'm not going to spend a lot of time on this slide, but it's important to note, if you go and got an internship at a public accounting firm, they probably are not going to call you part of the auditing practice. They'll refer to you as part of the assurance practice. The reason why is these are broader concepts of auditing. What these represent are going to be a little bit more detailed later on. We're actually going to have a chapter where we're going to talk about attestation and assurance. But for right now, it's important to note that auditing is a subset of both attestation and assurance. That's the important concept to remember. All right, I want to talk about this one. It's one of my favorite things to talk about. So a few philosophical thoughts. Is it possible to do well in an exam without knowing the material covered on the exam? What do you guys think? I mean, generally speaking, no, but is it possible? Yes, okay. All right. You could guess and get really, really lucky, or you could cheat. Okay. Nobody wants to admit that, but that's a way you could do it. Okay. And cheat and get away with it. Are there reasons for why the most competent and qualified candidates for a job might not get hired? Yeah. So somebody might say things on their resume that are untrue. So everybody remember George Santos? He kind of said some things that probably were not true. Yeah, about his qualifications. Yeah. It's the go-to right now. Yeah, so say qualifications about their abilities and represent those on the resume. What about a more broad question? The ends justify the means. If you get the job, does it matter if you misrepresented your position? No, Dr. Barnes, I got the job. What are you talking about? Everything's good. If you get an A in the class, does it matter if you cheated in the class or not? So this is kind of interesting because one of the things that I was concerned about back many years ago when I was taking auditing, one of the focuses was back in auditing is that they just wanted to concern themselves with the end result. That's all. And a lot of times that's all auditors focus on. They didn't care about what the means to achieve a particular end was. They just focused on the end result. Now, the analogy I'm going to use, this is going to be a little bit gross. Everybody knows my favorite food, right? Have we forgotten already? Cheeseburgers, yes, cheeseburgers. Okay, cheeseburgers. So let's say that I go to my favorite restaurant, Seabreeze, which is north of Kirksville, and I'm getting ready for a cheeseburger. I'm really looking forward to it. And I see back in the kitchen, they're preparing my cheeseburger, and the person preparing my cheeseburger sneezes on it. Okay, is that going to change my perception of the cheeseburger? Yes. Is that going to be a delicious cheeseburger? It probably still is, but am I going to eat it? No. So can we say that the ends justify the means? Not necessarily. The means are really, really important. So what does this important mean? So it's like prior to 2002, audits focused mostly on financial statements or free from material misstatements. Testing of internal controls was optional and frequently an afterthought. But then Sarbanes-Oxley Act came along and said, we're going to require auditor testing of internal controls. The idea being is that financial statement users should be able to know how companies achieve their financial results. So pairing this with what we're going to be doing, we're not only going to be concerned with whether the financial statements are free from material misstatement, but we're going to be concerned about what is the nature and operation of internal controls in the organization. That's going to give us the how, and then the financial statements will give us the what. So we're going to be concerned with both. We're going to be concerned with both. All right. Let's going to wrap this up. Okay. Types of auditors. Well, we know the external auditors. This is going to be the focus of this course. These are people who are hired by a client externally to come in. Companies like KPMG, Deloitte, EY, PwC, these are examples of accountants that are primarily focused on external audit. They also do other public accounting work, but when we talk about assurance, they're external auditors. We're also going to talk a little bit about internal auditors. These are parties who are hired by the client directly to perform functions within the organization. We've also got governmental auditors who do governmental research and assurance work. and then forensic auditors, which is my favorite because I'm a former forensic auditor. So yeah, 2 thumbs and a forensic auditor, this guy, yeah. Such a cheesy joke. Anyway, what are some other audit services we're concerned about? Internal control audits. We're going to talk a lot about these in this course because these are required under the Sarbanes-Oxley Act, Section 404. If it's a public company audit, the auditor is responsible not only for testing the financial statements, but testing internal controls relating to financial reporting. Okay. Now it's very specific, not just internal controls in general, but internal controls as they relate to financial reporting. That's why we actually have 2 sections on internal controls, because we're going to talk about internal controls in general, and then we're going to talk about internal controls for financial reporting specifically a little bit later on in the course. We also can perform audits in other areas. Compliance audits. Compliance, remember that term, laws and regulations. We're concerned in making sure that the client is following proper law rules in their industry. Operational audits. This is an audit over operations and making sure they're following standards and practices that are set up in the organization. This would be an audit that Dr. Otero probably wouldn't mind doing because it's more about the day-to-day operations of the organization. And then forensic audits. This is more of a review for fraud, and it usually occurs to determine if fraud compliance practices are necessarily in place, or if a fraud has occurred to determine what needs to be improved. Auditors can also engage in other type of attestation assurance services and some non-audit services, though many of these are now prohibited by the SEC. And you might be curious as to why that's the case. The answer to this is, prior to 2002, the auditing profession was self-regulated. So auditors reviewed the work of other auditors. At that time, auditors also had the ability to perform many non-audit services. So if you were an auditor, you could also perform tax compliance and planning or creation of accounting information systems, all these other things that you could make money on. Okay. What happened in 2002? Did anybody remember? There were a few things that happened. There was this thing. Has everybody heard that company before? If you haven't heard that company, where have you been? Okay. This is like the gold standard. This is like the big one. Everybody's like, if you're an accountant, you have to heard of Enron. Okay. So Enron, then we had WorldCom, we had Tyco, HealthSouth, Adelphia, all these massive companies that basically went bankrupt because of financial statement fraud. And these all occurred simultaneously. Enron was kind of like, when you set up dominoes and you let them fall down, okay? That was Enron. Enron was tipped, and all these others were dominoes that fell down on results. So yeah, big financial statement frauds that were occurring. And then shortly thereafter, there was this piece of legislation that I've already talked about before that occurred. There's a Congress Act that changed the face of accounting. Does everybody remember what that's called? Sarbanes-Oxley Act of 2002, or SOX, okay? Now, the reason SOX is important for us, it does dictate some of the rules that we have to follow as our profession, but it also created this group called the PCAOB, which was the first time that governmental oversight of auditing ever occurred. Now we have a governmental body making sure that we're doing our job properly. So what are some things that they're concerned about? Well, we want to make sure that we exercise due professional care. Due professional care is a concept in auditing that basically says we have to exhibit professional skepticism, an attitude that includes a questioning mind and a critical assessment of audit evidence. So I'm going to tell you a lot of things in this course, and you're going to take them as basically fact. And that makes sense in this particular context because you're going to say, Dr. Barnes knows what he's talking about, so he should. But there's going to be times where I'm going to say something, and you're going to say, that doesn't sound quite right. And I'm going to do that deliberately because I'm going to encourage you guys to question everything you hear in this course. I'm going to encourage you to exhibit professional skepticism. Sometimes you're going to exhibit professional skepticism, and I'm going to be like, well, I wasn't even trying to say anything skeptical, but you're absolutely right. Sometimes I'm going to say something that's completely and totally wrong and see if you catch it. That's the idea of a questioning mind. You want to make sure that you're questioning everything and assessing the evidence that's put in front of you. In addition to regulatory bodies, auditors are generally accountable to the governing body of organization and corporate governance. Have you guys heard of the term corporate governance before? What body is generally responsible for corporate governance of an organization? It's the board of directors of the shareholders, okay? But we're also going to be concerned about a subset of the board of directors, which we're going to talk about in more detail on Friday. That's going to be the audit committee. These are now required under PCAOB guidelines for any company that's audited under PCAOB rules to be in place. As a quick note, one thing that we're going to note when we get to the later chapters, this is going to be the last part of the section, the last third of this course. When we start applying audit procedures to specific process areas, we're going to be focused on some of the same ones we talked about in AIS. Remember the ones we talked about in AIS? We talked about revenue, purchasing, and inventory management. Those should seem familiar. We're also going to be talking about HR. It's a very short chapter, but it talks very closely about how we actually manage human resources. We're also going to talk 2 days about financing, which is basically going to be everything else on the balance sheet and the income statement that we didn't cover in the previous sections. So some of those are going to be pretty profound, like we talk about auditing a cash, which is really important. Talk about auditing investments. Some of those will be a little bit more of an afterthought, like property, plant, and equipment and prepaid expenses. All right. Last slide for today, or second to last slide, because I got my finished slide. One thing that we need to note is that auditing is very heavily under scrutiny for past failures. And one of the things that we should be very, very careful about is what that implies about our profession. So we need to understand what the nature of ethics is and how it relates to our responsibilities as auditors. So ethics is a system of code of conduct based on moral duties and obligations that indicate how we behave. I am one of those rare people that can think that says that you can't teach ethics because ethics is kind of an underlying characteristic. You can encourage it, but you can't teach it. But what I can teach you is I can say, what are the rules that govern ethics? Okay. That's going to relate to professionalism, which is the conduct, aims, or qualities that characterize a professional person. More importantly, we're going to be talking about the AICPA's Code of Professional Conduct. This is going to establish guidance for acceptable behavior for auditors. It contains principles, rules of conduct, interpretations of the rules of conduct. A major portion of the code identifies actions that may impair the auditor's independence. This is the big one right now. We're going to talk a lot about that over the course of the semester and determine what does independence mean from an audit perspective. When we talked about Enron, does anybody know who Enron's auditors were, the name of that audit firm? They're no longer in business now. Anderson, okay? Anderson was said to not be independent from Enron. And the reason why is because they had such a large amount of non-audit fees they were receiving. We need to be very clear about what impairs independence as an auditor, and we need to be looking out for those characteristics as we start determining whether or not an audit will take place or not, whether or not we can actually conduct the audit. After, I believe it's exam 2, we're going to be talking specifically about the Code of Professional Conduct, and there will be a lot of rules regulating what independence means within the context of auditing. That will be very important to understand. But right now, just note that we as auditors have to be independent from our clients, and that's kind of a dictate that we have to follow. All right, we are done for today. Remember, our first homework assignment is due on Friday. The homework questions are on Brightspace. Please make sure you submit that before you come to class. I'll see you then.